Okay, a sell and leaseback transaction. This is a transaction where a company, all right, sells its asset to another company and then later on lease it back. All right, they were initially the owners of the company. I mean, owners. So it's a movement from the owner to become a lessee. Okay, sorry, spelling of lessee. Okay, now, so these guys would have sold their assets. Okay, they were initially owners of the asset, but now they then disposed of the asset, okay, in a sell and leaseback transaction where after selling the asset, they immediately became the owners of, the lessees of their former asset, okay, or on their former asset. All right. This arrangement is good in the sense that it gives you finance. Let's say you are having a flat in town, okay, and you then decided to dispose of that asset. So, in other words, you are using your asset as some collateral for you to get the funding. So, some collateral security for you to obtain the funding. Okay, you have sold the asset, you get the money, all right, and then after that, you get the opportunity to rent that asset. All right. So in your bank account, you have obtained the funds. All right. And then you still have the right to use the asset. Right. So that's a sort of financing. You have obtained some funds in that trick. All right. There are a lot of those theories and so forth. Cash surpluses. All right. A cash surplus may arise over the short term, medium term, or longer term. Possible uses of surplus cash include the short term use. If you're having some surplus cash, obviously you need to reduce the short-term borrowings. Why? Because they are expensive and you do not need them for now. Why? Because you've got surplus cash. You need to invest in short-term treasury stock. Okay, treasury stock is normally cheaper. All right. Um, if you want to, to borrow, right? But at the same time, it's less risky if you want to invest in. So in this case, we are having a surplus, all right? So we can invest in short-term treasury stock. Short-term in the sense that when we want our money, we can easily, or it matures in a shorter periods. So when we maybe in this particular month we are having cash balances which are which are sufficing our operations. They are we are in a better or normal position currently. All right, we are fine. We are full in terms of our needs for cash. But maybe after 2 months, 2 or 3 months, we might run out of cash and would need that cash to be around. So if we invest in short-term treasury stock, all right, we would be able to then obtain our funds back. All right. What does it mean to invest in short-term treasury stock? What will we be doing? That could be the question. Okay, treasury stocks are stocks from the government. Okay, they could be some bonds. Okay, or let me just say certificates. They are usually certificates to lend the government. Okay, so we might lend the government money. Certificate to lend the government. All right. So if we give the government money, right, they give us those certificates. All right. It's like a share certificate. All right, if it was a loan, or if you buy shares from a company, listed company, you get a share certificate. Similarly, if you loan money to the government, they give you what are called treasury certificates or treasury stock certificates, something like that. So you have invested in the sense that you have put your money to the government, which will yield some interest. All right. Now, the reason why I'm saying that this type of investment is less risky is that it's very rare to hear that there is a broke government or a government that is going to fail to repay its lenders. All right. So this is, if you invest in the government, you are likely to get your money back. Are we together? Why? Because the assumption is that governments are not going to run broke. So you need to have that mentality when you read these things. Don't think of your government. Maybe you have heard that certain governments are broke, but when you are listening to this, think of an ideal government that is not going to run broke, that is going to pay its suppliers when they fall due, that is going to pay its liabilities when they fall due. Are we together? Good. So we need to invest in short-term treasury stock if we are going to have surplus cash in the short term. Therefore, we need also to invest in short-term treasury stocks in reducing our overdrafts. Right? Good. Third, we need to invest in a bank deposit account. We can put our money in the banks, on the assumption that that money is going to accrue some interest, okay, where we obtain what is called interest income, right? So if you put your money in the bank, the assumption is that you are going to get some interest income. Don't think of a situation in your country where if you invest or if you put money in the bank, you're not going to get anything. Don't think of that. Think of an ideal situation where you are going to get your money. You're going to get interest on your money which you have deposited in the bank. Lastly, invest in blue chip shares. Blue chip shares, these are shares which are very lucrative. Okay, they've got an earning potential. Their share prices are always rising and rising. So the advantage of buying those shares is that at any particular moment, your money is not the value of your shares or of your investment is not going to shrink. All right, it is going to arise, and they have got a readily available market. Those shares could be disposed of at any day. All right, there won't be any worries when it comes to disposal of shares and obtaining back your money. Remember, these are strategies to manage cash surpluses. So it was a surplus maybe this month, but it doesn't mean that the surplus is going to be always guaranteed. Sometimes we'll run out of cash. And when we run out of cash, there should be some ways of obtaining the cash back. So these were the strategies to ensure that in the short term, you are guaranteed to get your cash back. Then let us look at the longer term. We need to invest in new projects. Okay, here we are simply saying, if we are going to have a long-term cash surplus, a cash surplus that is going to take maybe years, all right, if we are going to have a cash surplus for maybe 2 to 3 years or 4 years, then we should also invest in longer-term new projects. Remember, short-term for short-term, long-term for long-term strategies. Are we together? Good. So we need to invest in new projects. Why new projects? Because this might be having a potential of multiplying our shareholder wealth. Then acquire other companies. Yes, if we still have good money, we need to acquire other companies, especially those companies which complement what we are doing, or they are in other markets which are so, are bright and prosperous, then we pursue the acquisitions of those companies. Then we also have to consider increasing dividends. This will make our shareholders happy, right? And eventually the share price is also going to arise or to increase. Then we can as well consider buying back the shares. If we buy back shares, this would eventually lead to the increase in share price. The share price is going to increase. But how? All right. Remember, let's say we were having 100,000 shares in the market. Okay, there were shareholders who were owning 100,000 shares. But if we buy these shares, maybe we buy some 20,000 shares back, it means the equity has been reduced to 80,000 shares. In the computation of earnings per share, it means when we were computing the earnings per share, when we were having 100,000 shares, sorry, what's happening? What's happening? What's happening? So, okay. When we were calculating, what's happening? What's happening? Okay, let me just leave this place. Let me just leave this. Let me try to use another pen. Okay, so let me say EPS, the earnings per share. Earnings per share, let's say we know that earnings per share is the earnings, or let me just say the PAT, profit after tax, over the number of shares. Remember that, number of shares. All right, so if the profit for the year was, let's say, 2 million, okay? 2 million over the number of shares, which were 100,000. Here it means the earnings per share would be 20 or 200 cents. Is that it? Not 200 cents, but 2,000 cents, isn't it? $2, that's a, so that's 2,000 cents, right? Yes, 2,000 cents. Then if now in the new arrangement, the new EPS would become the part using the same part figure of 2 million, 2 million over 80,000. So it means in this case these zeros cancel out. Okay, 8 into 200. Where's my calculator? The calculator is there. So we are saying 200 over 80. So you can see that the earnings per share has become $2.50. Why 250 when there I found 20? Let me cross check. I'm saying no. It's 200 over 8. Okay, so it becomes 250. 200 over 8. That's okay, that's 25, not 20. So it becomes $25. All right, so this was an increase. Initially we had found $20, okay? that's $20. But now, because the equity has reduced, it means that the EPS has increased. So that's the advantage of buying back the shares which we have we had initially issued to the market. All right, now let us reason in terms of business valuations. Using the PE ratio method of valuation, we are saying that the business value is equal to the earnings, right? The earnings multiplied by the share price. Multiplied by the price earnings, the PE ratio, rather. Okay, the earnings multiplied by the PE ratio. So the assumption which I gave you is that if we buy back the shares, the EPS is going to be higher. All right, the earnings per share is going to be higher, and that would motivate the share price to increase. Why? Because investors are seeing the investment as lucrative and prosperous. So in that regard, the share price is going to be higher. Also, the other dimension of reasoning is that as the shares are now lesser in the market, the demand for those shares is going to increase. Okay, remember, when products are few, demand is high. All right, so the shares are now fewer in the market. That will motivate the prices to increase. All right, so the assumption now is that the price earning ratio, okay, the price earning ratio for the firm where the equity has increased can be said to be, let us say, 3. Okay, the PE ratio here is 3 times, right? This one is 3 times. And for the firm with a higher equity, okay, or the earnings of $20, the earnings per share of $20 could be, let us assume that this one, the PE ratio is 2 times. So the value of the business for the firm, let's say for the first firm where the earnings per share is $20, could be said to be is equal to earnings of $20, okay, multiplied by, assuming that the shares were having a nominal value of $1. So we just pick the 100,000 shares as they are. So multiply by 100,000 shares. All right, multiplied by the PE ratio of 2 times. The assumption is that their PE ratio is lesser than that with a lower equity, than that of a lower equity of 80,000 shares. So the business value here ends up to be okay, somebody might be worried and say, why are you multiplying by the 100,000 shares which are not part of the formula there? All right, I'll explain that. Don't worry. Okay, so that's 20 multiplied by 100,000 shares multiplied by 2. So here we get a 4 million market capitalization, or the value of the firm. Okay, now using the same logic for firm 2, the second firm now, where the EPS is 3 times. So we just come here and say this was firm 2. Okay, the EPS was $25. So we use the same $25 multiplied by the EPS was 3 times multiplied by number of shares. This time the number of shares are 80,000 shares. Well, there's a call. Hello? Okay, let me look for the calculator. All right, so we are saying that one is 25 multiplied by hey, my screen, what's happening here? Multiplied by 3, multiplied by 80,000. Okay, that's fine. So you can see that here the market capitalization, the business value has grown to 6 million. Yes, I've used hypothetical numbers, but I wanted to drive the point home that if we reduce the equity, it means that there is a potential for the share price to go up, motivated by the increase in the earning potential of the share, all right, the earnings per share, something like that, all right. That's the idea. Anyway, we'll cover much of this in future lectures on business valuations. That was just a touch up. The last point we need if we are having long-term surplus is to repay long-term loans. All right. So that will be the position when we are now having a long-term surplus. Obviously, that will be a conducive moment to repay the long-term loans. Now, there is much theory in the notes which I gave you guys, and you just have to read on your own. I'm going to give you, to take you through the two main models we're going to use in cash management. The first model is the Baumol model, and the other one is the Miller-Orr model. We're also going to do an example on cash budgeting. All right, there is going to be an example. I'm going to do a cash budget question for you, just for you guys. All right, so see you there. See you in those videos. Thank you. So, okay.